What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of Intuitive Surgical, the medical device producer and supplier. With the recent run up in a lot of technology and AI related names, I believe it's important for us to take a look at some companies that are outside of the box, yet still part of the AI space, and Intuitive Surgical meets that criteria. So in this video, we'll take a look at a few valuation metrics to see if this does offer a good entry point for investors long term. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on June 15th, 2026. Let's dive right in here to the past 12-month price chart for Intuitive Surgical shares. You can see that within that time frame, shares underperformed the S&P 500 in this case by negative 41.2%. On a year-to-date basis, shares also underperformed the S&P. S&P is up 9%, whereas shares of Intuitive Surgical are down on a year-to-date basis 26.5%. I want to mention, even though we're seeing a steady decline since really November, December of 2025, the medical devices space as a whole has experienced a sell-off. Whether you look at names like Boston Scientific, still a great company, made a major acquisition, which the market has punished. Look at Danaher, Stryker, Medtronic, all great companies, yet the industry and sector as a whole has experienced a sell-off in markets. I want to mention that Intuitive Surgical sell-off has not been as pronounced as a lot of these other names in the medical devices space. Yet we can see in that graph above, shares have now traded below the 50-day and 200-day moving average. And really in February, March of 2026, we do see that 50-day moving average in the green trade below the 200-day moving average in the orange, which does indicate a technical sell signal. And we're not seeing shares actually trade above that 50-day moving average. So there is no positive momentum on a technical basis right now. On the flip side, you can look at that and say that shares are appearing to be oversold. And when you look at the relative strength index, that value is closer to the low 20s right now. A few key items I want to point our attention to. You look at that earnings per share growth through 25, 26, and 27. You're looking at around 13% on a compounded annual growth rate for those earnings per share. I believe management is being conservative on their outlook. Historically, they have been very conservative and have actually reported beats and surpassed a lot of their estimates. So I wouldn't be surprised to see true earnings per share grow even more in the coming quarters. And you see that a lot in the sales as well. 21.4% sales growth year over year, a good trend. You did see a lot of pent-up demand post-COVID with those elective surgeries. That demand hasn't subsided. A lot of demographic changes and reasons as well that we'll touch on later on in the video. The world is not getting any younger. The repopulation rate is going down, which means that companies like Intuitive Surgical are going to be a lot more in demand in the coming years and decades. When we look at those gross margins of 66.3%, outpacing both the industry and the benchmark as a whole, net margins as well, I will say management is very prudent and very financially disciplined. When you look at those net margins of 28.2%, compare that to the industry as a whole of 13.2%, very prudent, and you're seeing solid returns on equity at 17.2%. So fundamentally still a great business with a sticky business model and moat. But when we look at some valuation metrics, look at that trailing PE of 50.5, the forward PE of 37.6, even price to sales at 14.2, I will say isn't the most value name right now, but I do believe with the business model that Intuitive Surgical has, the products that it produces, supplies, and services are in high demand, are in critical need, and that premium on that valuation should be warranted until we see a drop-off in demand of their products, which isn't foreseen by companies, by the management, by analysts, institutional money managers, nor do I see that myself with the world only getting holder. So let's dive right in here to the 28 analysts who have a average target price on Intuitive Surgical shares of $570.19, which does imply a 36.88% upside from where shares traded on June 15th, 2026. The most pessimistic analyst, who I will mention is the only analyst with a sell rating on the name, has a target price of $366, which does imply a negative 12.14% share performance, with the most bullish analyst having a $750 price target, implying shares will appreciate 80.05% from market close on June 15, 2026. I also want to point your attention to that top graph there. That solid blue line is the share price for Intuitive Surgical. That dotted line is the average analyst price target. We go back to September, October of 2025. Still wasn't as a big gap between the share price to average analyst price target. Yet we can see that gap close really through the share price rally in November, December of 2025. Has come down significantly since then, and we see that gap really widen between target price and share price. So I do believe there should be a revaluation in the name, meaning shares should appreciate to where the smart money believes the true value of Intuitive Surgical's business is at. And when you look at the valuation metrics on a 5-year average basis, look at that forward PE, currently at a 37.6%. Like I mentioned earlier, the 5-year average is a 54.8%, 5-year low of 34.3%. From where shares are currently trading is not too far off the lows on its 5-year average, well below the 5-year average of 54.8. Really, you're getting a solid business with solid growth at the cheapest valuation it has been in 5 years. I do want to mention that really from 2021, you did see a big explosion in not only Intuitive Surgical, but the medical device space as a whole. This did create an overvaluation in a lot of the names in the space. Intuitive Surgical was not insulated from this, which is why you look at these numbers on any of these metrics on a 5-year average being so high, is valuations have actually come down even though the business has grown. One of those cases where when a company gets too large in share price, or share prices get too high, they need to grow into their valuation, and Intuitive Surgical, I believe, has done that, and now shares are discounting future growth in the name, and I'll discuss why later on in the video. But when we look at those profitability ratios, solid in the high 60s on a 5-year basis on a gross margin, operating margin basis, really looking healthy. Net margins, you're not seeing margins actually compress relative to the industry as a whole. And I do believe, with reasons I'll touch on later on in the video, with the change in Intuitive Surgical's business model, we will see margins expand in future years. And you're starting to see that trend. Really, you look at that over the past 4 years in that 10-year trend graph. Look at those most recent 4 bar chart valuations on net margins, for example. You are seeing a steady growth from really year end 2022, seeing solid returns on assets, equity, total capital, and invested capital in the high teens, really remaining average. Unlike a lot of the names we've discussed in previous videos, CapEx is always going to be, I will say, a part of any company, especially one in the medical devices space and technology space. A lot of investment has to be done in research and development. Intuitive has to take part in that. But when we look at the heavy CapEx of a lot of the hyperscalers, Intuitive is definitely not spending at the same velocity and magnitude as those names. When we look at a profitability analysis, comparing that to the peers, really in this case, Medtronic is the number one, I would say, competitor to Intuitive. We can put in Boston Scientific. Now, Boston, with the acquisition they recently made, does tweak a little bit of The operations, I'll maybe make a video in the future about Boston Scientific. I think that's also a great company, but we'll stick to Intuitive right now. Comparing Intuitive to Medtronic really surpasses all metrics on your gross margins, operating margin, net margin, really better at allocating capital management is at Intuitive compared to Medtronic, and a more operationally efficient business with revenue per employee growing, which we'll see in the next slide. Again, all shares in the medical devices space has sold off. Intuitive has not sold off to the same magnitude. And I believe that is a tip of the hat to management by the market to really show the trust that the market has in management in navigating a lot of these issues that are facing the sector as a whole, whether that's higher input costs, greater regulatory scrutiny, potential for margins to compress in the future, and AI related threats. Intuitive is staying ahead of the game. And you can see that in the valuation of the company not decreasing to the same magnitude as its peers, and is operationally more efficient, has better margins, and management is much better at allocating capital than the group as a whole. And you see that in those numbers as well. Look at those 5 and 10-year compounded annual growth rate. Any metric, whether you're looking at sales and revenue growth, pre-tax income growth, operating income growth. Look at that operating income on a 5-year CAGR, almost 23%. Earnings per share on a diluted basis, I want to mention on a 5-year compounded annual growth rate of 21.8%, 10-year CAGR of 16.4%. All these values are trending in the right direction, which is what we want to see. So fundamentally, business is still doing well. I will say on a technical basis, shares are really being punished more than what they should be for the fundamentals that Intuitive has. And with all that cash, what has management done? Well, a lot of shareholder friendly things. They have repurchased shares at the highest pace since 2022. Now, shares have appreciated since then. They have declined over the past 12 to 18 months, but management is still net positive on those share repurchases. And even though Intuitive doesn't pay a dividend, these share repurchases act as an artificial dividend for long-term shareholders. When we look at the segments of Intuitive, very simple business when we look at it and compare it to other names we've compared in previous videos. The products will always be the bread and butter for Intuitive. The services and systems segment is something that we're really going to see a lot of growth in the coming quarters and coming years. And I'll touch on that in the next snippet. But this is as of their most recent quarter. And you're seeing systems growth of potentially 25% year over year. You're looking at great growth metrics in high margin segments of Intuitive. So I believe it's important for us to touch on a few key bullish points for investors and potential investors long term for Intuitive. I'll start with the market dominance. Intuitive has an extensive installed base of Da Vinci systems in hospitals globally. Once a hospital system invests in the platform and trains its surgeons, it's highly unlikely to switch to a competitor, and this does create a long-term moat for the company. The business model is not just about selling robotics. A significant portion of its revenue comes from the recurring sale of instruments, accessories, and maintenance and service contracts. As the number of installed systems grows, just through the law of large numbers, this reliable revenue stream should scale accordingly, and we saw that in the growth projections in the previous segment snippet. The rollout of the Da Vinci 5, the 5th generation system, is a key growth driver over the coming quarters for Intuitive. The platform includes advanced features like force feedback and improved digital integration, which are designed to enhance surgical efficiency and expand the types of procedures that can be performed robotically. Intuitive continues to invest in clinical trials to gain regulatory approval for new surgical indications. This expands their total addressable market. And like I mentioned before, the world is not getting any younger. As the global population ages, we're not seeing that same replacement rate for a variety of reasons, depending on demographic or geographic regions, but the demand for surgical procedures will increase. Robotic assisted surgery is increasingly preferred by both patients for shorter recovery times and less pain, and surgeons for precision and improved ergonomics. This places Intuitive at the center of long term demographic trends of an aging global population. While the US market is mature, there is still significant potential for growth in international markets such as Asia and parts of Europe, where robotic assisted surgery right now has a low penetration compared to that of the US. And we saw the financial discipline and the institutional backing that analysts and smart money has behind Intuitive, whether that's very favorable price targets from where shares traded at market close on June 15th, 2026. But hey, time will tell if this does pan out to be a good investment for investors long term. This is not investment or financial advice. Just wanted to present to you guys a little bit of my findings here. Please do hit that like and subscribe button and stay tuned for the next video.